Hello everyone, this video is to give everyone a quick overview of Chapter 16, Corporation Operation. This chapter is about Form 1120, Income Tax Reporting of Corporations. More specifically, is for C Corp. For any tax return filing, the first thing you will need to figure out is which tax year we're reporting the taxable income. What is the accounting methods used? Is it cash method or accrual method? Next, of course, you're going to report the income and deductions. There are some special deductions and loss limitation rules to watch for. And this is similar to the 1040 individual income tax filing as far as the calculation goes. But unique to business entity, for their taxable income calculation, a lot of times the calculation starts with the book income. Then layer on the book tax differences to get to the taxable income. So that's something that's very unique for a business entity. And that's where we're going to spend a lot of time regarding how to derive the book tax differences and how those book tax differences behave and how those book tax differences could impact the current year tax liability as well as future tax liability. And the tax year accounting methods, this is something it's for you to read. It's pretty self-explanatory. And corporate tax formulas, similar. Start with gross income, then get to the deductions, get to the taxable income, and later on the corporate tax rate 21%, and the regular income tax plus later on other taxes, credits, prepayment, and you will get to the final tax due and refund. So you can take a look of the Form 1120 and look at the different schedules and different line items and see where things are at. So when you're working on tax project number 1, you will have a chance to take a deep dive on 1120 and fill out some of the forms, some of the pages to have a better understanding what 1120 is about. Okay, next I'm going to move on to the charitable contribution deduction limitation. Whenever we talk about deductions, we always want to watch for the limitation. And the limitation in this case, the charitable donation, is limited to the 10% of taxable income before deducting any charitable contributions, the dividend received deduction, and the net capital loss carrybacks. So this taxable income before deducting all those items are treated as a modified taxable income. So this is kind of a benchmark to limit the deductibility of charitable donations. So before we get to the limitation, we have to first determine what's the value of the charitable donations, because the charitable donation can be done in the form of a cash as well as in the form of property. So when there's a property donation, depending on the types of property, the value of the deduction or the amount of the deduction will be determined differently. So for any property, capital gain property, then the value of deduction is based on the fair market value generally. For ordinary income property, the adjusted basis will be used to determine the amount of deduction. Next, we're going to take a look at the dividend received deduction. The dividend received deduction is regarding the dividend received from the subsidiaries of corporations. So in this case, if the corporation owns less than 20%, then the 50%, the corporation will get 50% dividend received deduction. However, the deduction cannot exceed the 50% of the corporation's taxable income. This corporation's taxable income, of course, is a modified taxable income we just talked about in earlier slides. So there's two. Based on the ownership percentage, they only get a percentage of a dividend received deduction. And on top of that, the deduction cannot exceed the 50% of the corporation's taxable income. And once the ownership percentage increased to the next bracket between 20% and 80%, then the corporation will get more dividend received deduction. And once the ownership reached the 80% or more, the 100% dividend received deduction will be applied, and the taxable income limitation will not apply in that particular case. And the taxable income is determined without regard for the NOL carrybacks and carryovers and the capital loss carrybacks, and without regard. And next, we're going to move on to the limitation on the business interest expense deduction under Section 163J. This business interest expense deduction are limited to the sum of business interest income and 30% of the adjusted taxable income and the floor plan of financing interest. So the deduction disallowed are carried forward indefinitely. So the Form 8990 is used to calculate the adjusted taxable income and the limitation on the business interest expense. Now we're going to get to the book tax differences. What are the book tax differences? The book tax differences exist due to the differences between the financial accounting, in other words, the GAAP driven income, net income, and the tax accounting based on the tax law. There are definitely some overlap between the financial accounting rules and the tax law, but there are certainly differences. So really from a tax perspective, we kind of have to understand what is the treatment, general treatment under the GAAP, then later on the differences between the tax and the GAAP, and to derive the taxable income. So on the tax return, specifically, the book income are reconciled to taxable income, and this reconciliation has to be reported or disclosed on Schedule M1 or M3 of the tax return. So what is favorable versus unfavorable BTDs? So in the favorable BTDs, generally speaking, decrease taxable income compared to financial income. So there are some examples of favorable BTD and unfavorable BTDs for you to take a look. But generally speaking, this book tax difference is really this favorable versus unfavorable is determined on a tax year by tax year basis. When we're dealing with temporary differences, this favorable unfavorable treatment can reverse in the future. Okay, permanent versus temporary book tax differences. Permanent differences means the difference between financial and taxable income do not reverse over time and impact taxable income or financial income, either taxable income or financial income, but not both. And some examples for you to take a look. And the temporary differences is the differences between financial and taxable income that does reverse over time, and is causing a timing mismatches, but result in the same total income over the long term. And the perfect example of the temporary differences is the depreciation, because overall, under the financial accounting rules, they're generally speaking, they're using the straight line method for financial reporting, but for tax, the makers is more accelerated depreciation schedule because they're using the double declining method for depreciation. And for prepaid expenses, it is deductible for tax when it's paid, but expense for financial reporting as incurred. But overall, over the long-term period, the total deduction will be the same between the tax and financial accounting. There are common permanent book tax differences. This is something for you to take a look, and those also will be reflected on the Schedule M1 or M3. Those are the common temporary book tax differences. Okay, let's take a look at the dividends received from domestic corporations. The dividend received deduction definitely it's a heavily tested item on the CPA exam because it's unique characteristics. Because for dividend received from the domestic subsidiaries, from a financial accounting perspective, if the ownership is less than 20%, the dividend is included in the book income. But if the ownership is at least 20%, but not more than 50%, the receiving corporation reports its pro rata share of distributing corporation's income under equity method and does not include a dividend in book income. So really, when they're saying the pro rata share of distributing corporation's income is saying, let's say if the ownership is 30%, then the corporation will be required to include 30% of the distributing corporation's income into the financial income, and they will not include the dividend income in the book income. But if the ownership is more than 50%, under the GAAP consolidation rule, the intercompany dividends will be eliminated for tax purposes. But for tax accounting, the dividend received is always included in the gross income, and from an income inclusion perspective. But on the other hand, the corporation is also eligible for dividend received deductions, depending on the ownership percentage. So in a sense, the dividend received from a domestic corporation definitely is not fully included in the corporation who receives the dividends. And because even though they include the dividend distribution 100% in the gross income, at the same time they are also getting a haircut depending on the ownership percentage in the form of dividend received deduction. Next, we're going to take a look at the stock option. This stock option is discussed in the context of employee compensation, because a lot of times the corporation will grant stock options to the employees as an incentive or for additional form of compensation. And depending on the type of the stock option, the tax treatment is different, and the book treatment is slightly different as well. So in this particular case, for incentive stock option, for book deduction, the deduction is done per year over the service period, and the initial estimated fair value of the stock options divided by the service period will be the deduction for book purposes. And for tax purposes, there's no deduction whatsoever. So therefore, this incentive stock option create a permanent unfavorable book tax difference. For the non-qualified stock options, NSO, the book deduction is similar to the ISO, and for tax deduction, it's quite different. The no deduction until exercise, there will be no tax deduction for the corporation until the non-qualified stock options is exercised. The tax deduction is up to the amount of the bargain element and the fair market value exceeding the exercise price on the date of exercise or zero. So for that matter, for the non-qualified stock options, there will be a portion of the book tax differences will be permanent, and there will be a portion will be temporary. So that's why it's this book tax differences on the stock option compensation is quite unique. Next, we're going to take a look at the net capital loss limitations. There will be no current deductions for the net capital losses, and the net capital loss can be carried back 3 years and carry forward 5 years. So the carryover amounts will be used on a first in, first out basis. Net operating loss deduction, that's the NOL. So generally speaking, there's no current year deduction for current year losses because the taxable income cannot be below zero. The NOL utilization only occur when there is a current year taxable income. And as far as utilization goes, due to the TCJA enacted in 2017, there are different buckets. But since right now we're in 2025, some of the rules will not apply, but This is kind of the general bucket we have to watch for. Depending on when those NOL are originated, the carryback and carry forward rules are slightly different. Plus, the other thing is we want to make sure we understand there's some portion of NOL, some buckets of the NOL can offset 100% of a current year taxable income, but some the NOL can only offset 80% of the taxable income. Finally, the compliance. Compliance, what is tax and compliance? Really what we're doing is we're trying to gather all the information and to prepare Form 1120 and file the tax return on time before the due date. And a small corporation, as far as book tax differences disclosure, only need to complete Schedule M1, it's a relative simplified version of book tax differences reconciliation. A large corporation that has to complete Schedule M3, and the book tax differences are referred to as M's adjustment or Schedule M adjustment. The corporate returns are due 3.5 months after the close of the tax year, but generally the large corporation will file extension, or they will take advantage of the automatic 6 months extension for filing. So a lot of the large corporation will have literally 9.5 months to file their final tax return. And a consolidated tax return, basically just saying, is for any entities within any corporations, any subsidiaries owned by the parent company with more than 80% or more, will be consolidated as one entity. So it's going to file one return. So affiliated groups essentially are treated as one corporation. Estimated tax payments is something is also required as corporation level. This is something for you to take a look. With that, I'm going to conclude this session.